Okay, this video covers what the disclosure of equity investments looks like on financial statements. An equity investment is when a company buys a fraction of another company. So one company has ownership in another company. How does the company that's making the investment disclose that ownership? We're going to go through Berkshire Hathaway, and we're going to go through three different types of equity investments. For accounting purposes, we split it up into three different types. If the investor owns 0 to 20% of the investee, we consider there's no influence in that ownership relationship, and so we account for it one way. If the investor owns between 20 and 50% in the investee, we consider that to be significant influence in the operations of the investee, so we account for it another way. And then the third way is between 50 and 100%. If a company owns 50 and 100% of another company, we assume that they have control of of the company that they're invested in. So we account for it another way. And so let's go through those three with Berkshire Hathaway. And now I think I need to go up to the corner and become a little smaller. And I'll get the laser pointer. Okay, so we're going to go through three different investments that Berkshire Hathaway has made, and these are equity investments. So they have bought ownership. They have bought equity ownership. So they have ownership in three different companies. They own about 6% of Apple. They own about 27% of Kraft Heinz, and they own 99% of Dairy Queen. And so each of these falls into a different category for accounting purposes. Just as a preview, so the investment in Apple, on Berkshire Hathaway's balance sheet, they're going to hold that investment at fair value, and the income statement is going to reflect changes in fair value as those changes occur. For Kraft Heinz, they own 27%. We're going to use the equity method. So the balance sheet investment account is going to be held based on the equity method, and I'll show you a little bit more about what that means. And the income statement is going to reflect Berkshire Hathaway's percentage share in Kraft Heinz's net income. So the income statement of Berkshire Hathaway is going to contain 27% of Kraft Heinz net income. That's going to be called equity method income. Finally, for Dairy Queen, they own 99% of Dairy Queen, almost 100%. They have control of Dairy Queen. Berkshire Hathaway has control. So they consolidate. And consolidate means that all of Dairy Queen's assets and liabilities appear on the balance sheet of Berkshire Hathaway. Since Berkshire Hathaway does not own 100%, there's a 1% non-controlling interest in Dairy Queen. And so they're going to report that non-controlling interest in the equity section. And I'll show you what that looks like. Finally, in Berkshire Hathaway's net income, we're going to see 100% of the net income of Dairy Queen in the revenue caption, in the cost of sales caption, everywhere. So it's going to just show up consolidated in the income statement. And we're also going to see a reduction based on this non-controlling interest. So I'll show you what that looks like. So let's move on to see what it looks like. Here's the balance sheet of Berkshire Hathaway. And a couple of the accounts we're going to be looking at. Apple's fair value is contained in this account here, investments in equity securities. So that 248 billion, that contains their investment in Apple. In this equity method investments line item, this contains their investment in Kraft Heinz, their equity method investment. And then Dairy Queen, we're going to see is just everywhere on this balance sheet. So let's start out with Apple. So I'll zoom into this section where it says investments in equity securities of 248. In that line, that's where Apple is. And Apple is held at fair value. So when you go to the footnotes that describes this line item in more detail, here's what you'll see. And by the way, changes in Apple's fair value are going to be reflected in net income. Okay, so I'll show you more about that in a minute. So here's the details of footnote 4, and footnote 4 is all for Berkshire Hathaway is all about investments in equity securities. And here they break down all the different types of equity securities that they invest in. And I believe Apple is going to be in this consumer products line item. And you can see that in this table, they'll have the cost basis of their investment. So the cost basis represents what did Berkshire Hathaway pay when they purchased those shares on the open market. That's their cost basis. They've also had some net unrealized gains. So all of their investments have increased in value since they originally purchased them. And then you have the fair value, so the current market value of those investments. So this fair value takes the cost basis and is increased by the net unrealized gains. And when you add that in, you get fair value. So the fair value of all of their consumer products equity investments, non-significant influence equity investments, is 99.6 billion. And here they have a footnote down here which says, and I think I've highlighted this, that Apple represents 73.7 billion of that amount. So 73.7 billion of this 99.6 billion amount is the fair value of their equity method investment. And if you were to take 73.7 billion and divide it by Apple's total market capitalization as of December 31st, 2019 here, you would get around 5.7%. So that's around what percentage Berkshire Hathaway owns in Apple stock. Okay, so that's where Apple is on the balance sheet. Now let's just look at the income statement. So in the income statement under this revenues category here, they've got a caption for interest, dividend, and other investment income. And so this amount here, this 9.2, I think this is 9.2 billion, this is going to contain changes in the fair value of Apple's stock. So when Apple stock goes up in value, which it's been doing a lot recently, Berkshire Hathaway's increase in their portfolio value, so the Apple stock price goes up, so Berkshire Hathaway's share of that company increases in value as well, and that share of increase in value is reflected within this 9.2 billion here. So that would, in other words, the journal entry behind, let's say Apple makes a gain for the year, it's going to be a debit to the investment account on the balance sheet and a credit to this investment income account on the income statement. That's the journal entry Berkshire Hathaway records when Apple's stock price goes up. Okay, so that's Apple. Now let's go through this line item here, equity method investments on the balance sheet, 17.5 billion. And this line item contains their investment in Kraft Heinz. And this does not contain the fair value of that investment. This contains the equity method basis of that investment. And I'm going to tell you what that means now. So within the 17.5 billion is the equity method basis of their Kraft Heinz investment. And here is a paragraph from a footnote 5 about their equity method investment in Kraft Heinz. And I'm just going to read it in case you can't. Shares of Kraft Heinz common stock are publicly traded, and the fair value of our investment at December 31st, 2019 and 2018 was approximately 10.5 billion and 14 billion respectively. Okay, so they just talked about the fair value of the Kraft Heinz investment. For accounting purposes, that is ignored. It's disclosed for the benefit of investors, but that is ignored for accounting purposes. We ignore changes in fair value. Okay, now we're talking about accounting starting here. The carrying value of our investment at both December 31st, 2019 and 2018 was approximately 13.8 billion. So let me stop there. When they say carrying value, that's another word for book value. And book value is the value that is reflected on the balance sheet, okay? The balance sheet is the book. And so when we say carrying value or book value, we mean balance sheet. In terms of carrying, the balance sheet is carrying the value, okay? So when they say the carrying value was 13.8 billion at December 2019 and 2018, so their carrying value has stayed the same, that's the equity method basis, has just stayed the same all year. Let's do the T account. So here's the Kraft Heinz investment T account. And what they just said is that the book value has been 13.8 billion at the beginning and ending of the year. So I can plug in 13.8 billion as the beginning balance, which is a debit, and the ending balance, which is also a debit. So let's read further in this paragraph now. We recorded equity method earnings of 493 million in 2019. Okay, so they record equity method earnings. That 493 million represents 27% of Kraft Heinz 2019 net income. So you take Kraft Heinz 2019 net income, multiply it by their 20% share, and that is the equity method income that Berkshire Hathaway records on their income statement. What is the journal entry? Well, that's going to be a debit to the investment account for the share of net income. That's the debit of the journal entry. The credit is reflected on the income statement, which I'll show you later, to equity method income. So a debit to the investment account and a credit to equity method income for your share of the investee's net income. So 27% of Kraft Heinz net income. Okay, next, they talk about the prior 3 years of income. So Kraft Heinz had losses of $2.7 billion in 2018. That was because of a goodwill impairment, and earnings of approximately $2.9 billion in 2017. So they had earnings in 2017. But we're just talking about, this T account is just for the 2019 year. So I'm going to ignore the earnings in the past. That all goes into what the current equity method basis is at the beginning of the year. Okay, intangible asset impairment they talk about, and now we'll talk about this sentence starting right here. So next, we received dividends on the common stock of $521 million in 2019. And then they say 2018 and 2017. So this $521 million in dividends that Berkshire Hathaway received from Kraft Heinz, that journal entry is a little confusing sometimes, but that is going to be a debit to cash because Berkshire Hathaway is receiving cash when Kraft Heinz pays that dividend. And it's a credit to the investment account of that $521 million. So Berkshire Hathaway records a reduction in their investment in Kraft Heinz when Kraft Heinz makes a dividend. And the reduction is just the Berkshire Hathaway share of that dividend. The confusing part is, why is our investment account decreasing when we receive a dividend? And the answer is that Kraft Heinz, when they issue a dividend, well, Kraft Heinz is now a smaller company. And so the basis of our investment is now smaller since we own the same percentage of a smaller company. And that's why it's a reduction in the investment account. So just to look at this investment account as a whole for the year, it had a beginning book value of $13.8 billion. We had a share of net income of $493 million, a share of dividends of $521 million. And since our share of net income is approximately equal to our share of dividends, materially equal, the ending book value just remained at $13.8 billion. So it didn't affect the rounded amount of the ending book value. So that was the T account for Kraft Heinz during the year. And basically what the balance sheet looks like. Now let's just quickly look at the income statement. So here's the consolidated statement of earnings. And this is a little bit farther down on the income statement. So there's revenues, then there's other types of expenses and gains and losses. And then you get down towards the end. So this is earnings before income taxes and equity method earnings. Okay. And then the line right below that is equity method earnings. So here is $1.1 billion of equity method earnings. And that $1.1 billion contains I believe it was $493 million for Kraft Heinz. So almost half of that equity method earnings is their equity method earnings from Kraft Heinz. And remember, that was a debit to the investment account on the balance sheet and a credit to the income statement. So here's where that credit to the income statement shows up, and it increases net income. So yes, so Kraft Heinz share of net income is included in this line item. And you can see why it's so significantly negative in 2018, because Berkshire Hathaway had to reflect their share of that huge net loss that Kraft Heinz had in 2018. And Kraft Heinz had a huge net loss in 2018 because they had a large goodwill impairment. So that's why it's so negative here in 2018. Okay, moving on. So now we're going to talk about Dairy Queen. Dairy Queen is Berkshire Hathaway owns 100%, or no, Berkshire Hathaway owns 99% of Dairy Queen, 99%. Berkshire Hathaway has control of Dairy Queen. So they consolidate Dairy Queen at 100%. Dairy Queen's balances are all over this balance sheet at their 100% book values, okay? Dairy Queen is everywhere. So for example, Dairy Queen's property, plant, and equipment. So all of those machines that make blizzards, that is equipment. And 100% of those balances are included in this Berkshire Hathaway property, plant, and equipment balance. So this $21.4 billion includes the full book value of Dairy Queen's equipment. And you could say the same thing for all of these line items. Okay, and I believe Dairy Queen's going to be in this other business line of business. I don't think Dairy Queen is considered a railroad, utility, or energy. Even though you might get energy from a blizzard, it's probably considered other, where other represents ice cream and hot dogs. Okay, so that's where Dairy Queen is in terms of geography on the balance sheet. It's consolidated. Next, let's look at the shareholders' equity section of the same balance sheet. So I just showed you assets. I skipped liabilities, and now I'm showing you shareholders' equity. By the way, 100% of Dairy Queen's liabilities are going to be reflected in the liabilities section of Berkshire Hathaway's balance sheet. I just didn't show it to you. So now let me show you the shareholders' equity section of the Berkshire Hathaway balance sheet. And what I want to show you is Berkshire Hathaway's shareholders' equity is $424.7 billion. And there's a non-controlling interest. And when you take that and when you put that in, there's a total company shareholders' equity of $428.5 billion. So this non-controlling interest includes other companies as well, perhaps, but this balance includes 1% of Dairy Queen. So when you look at the property, plant, and equipment balance, that's 100% of Dairy Queen's property, plant, and equipment. But Berkshire Hathaway's equity is only 99% share in that asset. And so when you add in the non-controlling interest, you get total 100% shareholders' equity of 100% of the assets and liabilities. So this non-controlling interest tells shareholders of Berkshire Hathaway, hey, you only own $424.7 billion of that book value, of that total company book value. You don't own $3.7 billion of the book value that you see on the balance sheet. The total balance sheet has a shareholders' equity of 428.5, but hey, Berkshire Hathaway shareholders only own 424.7. Okay, so that's what that is saying, and that's how non-controlling interest is reflected on a balance sheet. You might also be seeing this called a minority interest. Okay, now let me show you the income statement. So, hey, Dairy Queen could be anywhere on this income statement. It's fully consolidated. We reflect 100% of Dairy Queen's sales and expenses on Berkshire Hathaway's income statement, 100%. But I think it's probably in sales and services revenue, okay? I think that's probably where Dairy Queen is. So I think this line item here contains 100% of Dairy Queen sales. When Dairy Queen sells a blizzard, that sales revenue is within this amount. So blizzard revenue is in that $134.9 billion amount. Blizzard cost of blizzards sold is included in this $107 million amount. Selling general and administrative expenses of selling blizzards and hot dogs is included in this line. I've kind of covered up the balance here, but it's included at 100%. So now let me show you the bottom of this income statement, which shows, okay, well, total net earnings was $81.7 billion, but Berkshire Hathaway investors, you don't own 100% of that earnings, partially because you only own 99% of Dairy Queen, and there's other investments as well. But here, this is the earnings that's attributable to non-controlling interest, $375 million. So Berkshire Hathaway investors, you don't own the $81.7 billion of net income. You only own $81.4 billion of that net income. So it's telling Berkshire Hathaway investors they don't own all that income. There's a non-controlling interest, sometimes called a minority interest. Okay, so that represents, among other things, 1% of Dairy Queen's revenue minus expenses. And so their net income. Okay, that's all I wanted to show you. So pretty complicated. Equity investments are a pretty complicated thing. And we went through 3 different kinds. We went through when you own less than 20%, which was Apple. We went through when you own between 20 and 50%, that was Kraft Heinz. And we went through when you own more than 50%, and that was Dairy Queen. And the complication with that one was there's a non-controlling interest and how that's reflected. Okay, so I hope you had a good time. I know I did. And I'll talk to you next time. Bye-bye.